All right, so this is a question very similar to the type that you're going to see on the quiz. I'm going to try to keep things pretty straightforward. I'm not going to go into like extreme specifics. I'm not going to give you a bunch of different potential itemizations and potential above the line deductions and have you sort through them. No, I'm just going to tell you total amounts here. 19,250 in potential itemizations, 5,000 above the line deductions. I'm trying to keep it pretty simple here. Okay, let's not be overwhelming. And there's all kinds of questions I could ask here. I could ask for their Medicare taxes, Social Security taxes, AGI, gross income, right? There's a lot that I could ask for. And let's just go through just focusing on U.S. income taxes, okay? All right, so for U.S. income taxes here, let's go through the steps. We start with total income. That's given to us in the question. They have $100,000 in total income. So that's like how much they earn if they didn't withdraw anything and there were no taxes, all right, at $100,000. The next thing we have to do is convert that into their gross income, okay? And let's assume that like most people, their insurance is set up through their employer and everything, okay? So for this person here, let's see what is never realized as income. What things do they never really see as income? Well, the traditional 457B, that $19,500, they never really see that as income, okay? The $3,000, they never see as income. And the $8,000, they never see as income. So there is what? $30,500 that's going to be taken away before they really have any chance to earn it. So if you look at their pay stubs, you'll actually see on there like total income listed, and then gross income also potentially listed. The stuff like 457Bs and HSAs never enters your banking account, all right? So that's what we're taking out here. What's the next step? The next step is converting to AGI, adjusted gross income. All right, from this point on, let's call it AGI. So AGI is probably the most important one to know because lots of eligibility for various things are based on AGI. We mentioned the Savers credit in the last video, for example. So AGI, what we're going to do is we're going to take out your above the line deductions. Why create a difference between above the line deductions and itemizable deductions? Well, the thing to recognize is above the line deductions will always be deducted, but itemizable deductions will only be deducted if you itemize. Okay, so the government's saying, look, here's stuff that everyone can deduct. Always you can deduct these things. For example, the interest on your student loan. When you make a payment, the interest you're paying is deductible as an above the line deduction, which is good for you. I mean, you'll definitely deduct it. So we've got $5,000 in above the line deductions. So we take out right there 5,000 bucks. Moving to step number 4, okay? Step number 4 is your taxable income. To get here, you have to make the choice, right? Do I go standard or itemize? This is a married couple, so married couples filing jointly can take the standard deduction of $24,800, right? Or they can take the itemized deduction, which in this case would be $19,250. In a way, it's kind of like they're wasting these potential deductions. All those charitable donations they're making, they don't get any sort of tax incentive for them because they are going to take the standard deduction. In Georgia, about 85% of filers take the standard deduction. For a lot of people, standard is better. I've looked at my taxes the last few years. I hire an accountant to do all this stuff because I don't want to deal with it. But I've actually itemized the last few years, but it's only barely been worth it. All right, so my itemizations have been just a bit more than the standard deduction. We'll see if that's true this year. All right, so what we're going to do is we're going to take $24,800 from that, and that will leave us with $39,700, I believe. And that is what we call their taxable income, $39,700. Okay? All right, what do we do next? Now we've got to figure out what their taxes are without without tax credits. Okay? So this is where we use our tax brackets up here. Their taxes, if they don't have credits, will equal 19,750 times 0.1 plus 39,700 minus 19,750 times 0.12. Okay? Okay, change of venue, working through this exact same question. I went ahead and solved for your taxes without credits. That's based on this formula here, okay? So recall what we've done so far is we started out with total income. We took out those things that aren't really income at all, such as 401k contributions. Then we took out above the line deductions. Then we took out here, you could either go standard deduction or take the itemizations. This person here went with the standard deduction, all right? Married couple, $24,800. And that leaves us with taxes solved as $4,369. Don't stop here, okay? Sometimes people make a mistake and think, look, they've solved for taxes, so they're done. That's taxes without credits applied. So in this initial question, we saw that they have 2 kids. So they're going to have 2 $2,000 tax credits. So their actual U.S. federal income taxes will just be $369. Not much taxes. You can kind of see how taxes aren't going to be as big of a problem as we have initially led on to. Basically, I've suggested that they are in the past because we weren't really prepared to deal with all of these intricate details with the U.S. tax system. So your tax burden is going to be a lot lower than what you may have anticipated in the past. But there are still opportunities to save. The fact that it's more complicated means there's more to know and more useful information for you to utilize. One interesting thing here is actually some people will go into the negatives. You can kind of imagine it wouldn't be that hard to end up with negative taxes. The rules there do get more complicated, but I will say in some cases it is possible to pay negative taxes, which means the government gives you money instead of you giving them money. That is possible, especially when you have a lot of kids. Okay, so for this person, they have taxes of $369. They would certainly want to understand how the system works so they can figure out the best ways to go about, receiving benefits and such. One thing to recognize about this couple here is that their marginal tax rate is never above 12%. And I usually recommend to people if your marginal tax burden is at 12%, I would say you probably should be doing more Roth contributions. Remember, the U.S. tax system has tax rates that jump from 10%, 12%, and then 22%. And this jump right here is a critical one. That 10% jump there, a lot of times is a good decision point for people. If your marginal tax rate is 22%, I often suggest consider to do traditional contributions more frequently because it's nice to reduce your burden down to 12%. If you're only paying 10 or 12% right now at your marginal tax rate, then I would make the argument to go Roth, okay? And this is sort of just standard advice for somebody who really doesn't know what their future career is going to be like. They don't know if their income is going to go up. They don't really know when they're going to retire. Well, generally speaking, I would say if your tax rate is at 10 or 12%, that's your marginal tax rate, like this couple here, that rate is so low, why not go Roth, okay? Because in the future, really best case scenario, your tax rate is 10% for a lot of people. So 12 versus 10, not a big difference. So you would certainly want to be able to anticipate all of this, and every step has its own potential useful information to you. We'll see later on in this video how adjusted gross income is useful in many cases. Certainly this step here where you solve for taxes is nice because it shows you what specific tax rates you're facing. And those things aren't obvious if you just look at your overall tax burden. That number right there doesn't tell us the story. So we need the story in order to make good decisions. All right, so in that last video, we went through an example that I think will be really helpful to you. I would definitely recommend take a look at the worksheet before you work through the quiz. Questions on the worksheet should take you through those steps that you need to solve for taxes. Practice is key here. In this video, we're all about really learning stuff that we can use to our advantage. It's not so much nuts and bolts. It's about what we can do to improve our situation. Stuff that you really need to take away from the last lesson. So, starting right here at the top, you should recognize that above the line deductions are better than standard deductions, and you should above the line deductions are better than itemized deductions, and you should be able to explain why. The reason is, above the line deductions always reduce your taxable income, but potential itemizations only reduce your taxable income when you are itemizing, okay? In other words, if I have a $1,000 above the line deduction, that will reduce my taxable income by $1,000 always. But if I have a $1,000 potential itemization, that will only reduce my taxable income if I'm itemizing, okay? Second one here, tax credits are always better than tax deductions. Hopefully you know what a tax credit is from the last video. Tax credits reduce your taxes, which is better than reducing your taxable income, all right? A $1,000 tax credit means you'll pay $1,000 less in taxes. A $1,000 tax deduction just means your taxable income will be $1,000 less, okay? There's obviously a big difference in value between those two. Number three, where you stand influences your decision, okay? When it comes to thinking about what decisions you should take, there is always going to be particular attention paid to the standard deduction versus itemizing, okay? For example, if you're single, you can take the standard deduction of $12,400. So you wouldn't itemize unless your itemizations are greater than $12,400. And I'm going to give you a couple of examples of where this comes into play that are maybe not so obvious at the forefront when you first start thinking about these things. So let's think about a scenario here. You're thinking about buying a house that has a value of $300,000. And of course, like most people, when you buy the house, you're going to have a mortgage. You do the math, you figure out that you'll have $6,000 in interest payments. You might recall from the last video that interest payments on the house that you live in are a potential itemization, okay? Which is not ideal. We'd rather than being above the line expense, right? So let's think about how good of a deal this house is, all right? There's two possibilities. One, let's say that you currently have itemizations of $5,000, right? You have not yet bought this house. Right now, your itemizations are $5,000. If you buy this house, will you itemize this year? The answer is no, all right? If you buy the house, that would push you up to $11,000 in potential itemizations, right? Adding $5,000 plus his $6,000 here gives you $11,000. So this person would still choose to take the standard deduction of $12,400. What that means is they're not really getting any benefit from the interest deduction, the mortgage interest deduction. People tend to think, you know, if you buy a house, you get interest deduction. Or if you give to charity, you get a deduction on that. That's only true if you're itemizing, all right? Because these are below the line expenses. Conversely, if you currently have itemizations of $15,000, what that means is you're already fully itemizing. So any additional itemizations that you include will automatically reduce your taxable income. So if this person decides indeed to buy the house, they would then have $21,000 in itemizations, okay? Effectively, this person here will pay less for the house than this person. So you'd want to think about where you stand in terms of itemization. And I don't hear people discuss this very often. You know, you look at a house and you say, well, the house is $300,000. Is it worth it or not? Well, the house is $300,000 in terms of its price tag, but the effective price you pay will be different depending on whether you take the standard or the itemized deduction. You see what I'm saying here? And it may not seem like a lot of money. You're saying $6,000, maybe that's not a lot of money, but mortgages usually last for 30 years, right? So 30 years of $6,000 in income deductions, you know, that could be $30,000, $40,000, $50,000 in tax savings. right, is not negligible. It's a big deal. Let me give you another example. It's kind of a wacky example here. But I actually have heard of people doing this. Let's say that the only itemizations that you have is you give to charity. All right, specifically you make donations to your church. You like to give $10,000 to your church every single year. You are single, so the standard deduction for you would be $12,400. All right, so if you give money to your church here, $10,000 a year, will you get a tax reduction? Will you reduce your taxes by making these charitable contributions? The answer is no. You have not reached the $12,400 threshold. So this is not going to reduce your taxes at all. Right? So what could you do? Rather than giving this amount every year, which would lead to deductions of $12,400 a year, you could get a little strategic. All right? Maybe instead of giving $10,000 every year, you decide to give nothing over 3-year periods, and then $40,000 in the 4th year. All right? As a result, what this would do is it would cause you to have much more deductions. It wouldn't affect the first 3 years because you're taking the standard anyway, but now you'd have itemized deductions of $40,000 in that 4th year. Kind of a crazy thing to do, right? But what's stupid about it? There's nothing dumb about it, right? I'm sure if you spoke to somebody at church and explained what you were doing, they would be fine with it. Especially because you could take the $10,000 and invest it in the meantime and end up with more money to give to the church in year 4, right? So this is going to reduce your taxes. This kind of thing is sometimes referred to as tax batching, which is batching a bunch of your potential itemizations into 1 year, all right, if possible. I don't know anybody personally that does this aggressively, but there are people that I've listened to, podcasts and such, that do this stuff aggressively. All right, so it can reduce your taxes by a significant amount. All right, number 4 here, my 4th key idea. I'm going to call this the weird Georgia-U.S. situation. All right, Georgia is in a strange scenario in regards to how standard and itemized deductions play out. Remember, in the U.S., if you are single, the deduction is $12,400. If you are married, filing jointly, double it, $24,800. Okay, that's what we know already. We haven't spoken about Georgia at all until just now. In Georgia, if you are single, it is $4,600. And if you are married, filing jointly, it is $6,000. I don't know where these values come from, but what I do know is they came up with these values a few years ago before some major tax law changes in the U.S. So it's like this is new, but this is old. And this is probably going to stick around for quite a while. Now, why does that matter? Okay? It does. It matters quite a bit, actually. Here's the deal. Just to understand what this is telling you is that if you are single, in Georgia, the standard deduction is $4,600. Otherwise, the same itemization rules apply. So, if you have itemizations of $20,000, that would reduce your U.S. taxable income by $20,000, and it would reduce your Georgia taxable income by $20,000. Typically, it's a bigger deal what happens in the U.S. because their tax brackets are higher, but you still care about both, okay? So in this scenario, you itemize, easy choice. Another possibility, maybe you have standard deductions of $2,000, right? Well, in this case, you clearly, if you're single, you clearly want to take the standard deduction in both scenarios. But let's think about a third scenario, $11,000. What you run into now is realizing that in the U.S., you want the standard deduction. But for Georgia, you would much rather have the itemized deduction. Okay? That's not even the weird part. The weird part is you have to choose one or the other. Okay? So you cannot in this scenario, this person, what they would like to do is take the standard deduction US and then take the itemized deduction for Georgia, right? Standard here, itemized here. That's what they would prefer to do. That is not an option. So what they're going to have to do is choose one or the other, the standard for both or itemized for both. And you can imagine that that decision is a mathematical one. In a prior class that I taught, I actually had them solve for it. I'm not going to do that to you guys right now. But just note, this decision would be a very tricky one for this person to make. These types of choices is why I really like to hire an accountant. I just don't want to deal with these types of calculations because things are so messy. It's just not worth my time to try to go through and calculate it all. So just keep in mind, you must make the same choice in terms of the standard versus itemized decision in US and Georgia. You can't do one for one and one for the other. Okay? I think there's a quiz question asked about this, so it should be pretty easy. All right. Let me just give you one last thing to think about. Really, a lot of what this class is about is allowing you to control your own destiny in regards to taxes. When I first said this, first time I taught this class, people laughed. I said taxes are optional. But that's true, right? That's what you're saying. If you don't want to pay income taxes, put more money into a traditional account, right? It's not so hard to do. So controlling your own destiny is a big deal. Let me just give you a couple of examples of what I mean by this. In regards to the saver's credit that we discussed in the past, the saver's credit fully applies to those with an income less than, I'm sorry, I'm making a mistake here. The saver's credit fully applies to those with an AGI, adjusted gross income, of less than $19,250. Okay? So why does this matter? Okay? Let's think about a real world scenario here. You are enabled now to solve for your AGI. It's not that hard to do. Okay? You can solve for your AGI, maybe not down to the penny in real life, but down to the thousand. All right? And so what might happen is you decide you want to figure out your AGI to determine your eligibility here. And you solve for it, and you find that your AGI is $21,000. Okay? Think about how that information is useful to you. Most people don't know what their AGI is. Most people, if you ask them what an AGI is, they're not even going to really fully understand what it means. Usually it's people that have a lot of money that know what an AGI is because they have the incentive to learn. You already know, okay? So if you figure out that your AGI is $21,000, think about what that means. If you make $2,000 in tax-sheltered contributions, and lots of things are eligible here, I believe you can do it, for example, into a Roth IRA, which would be really nice because your income's low right now, right? So if you make $2,000 in sheltered contributions, think what that does. Not only does it reduce your taxable income by reducing your AGI, but also you get a tax credit of 50 cents to the dollar. So the government would essentially give you $1,000 for that contribution, and your taxes would go down on top of that. For this person, this contribution, you see, is worth a lot of money to them. There's various examples of this type of thing happening. There's a child care tax credit. Not the child tax credit, but a child care tax credit. It essentially phases out when you hit $200,000 in AGI. Well, if you've got $250,000 in AGI, consider figuring out a way to reduce it down. Certainly if you have $201,000 in AGI, figure out a way to get it under that threshold. Here's another one. Roth IRAs are only available, fully available to people who have a modified AGI of less than $139,000. Modified AGI, just another extension of AGI, something you can learn about on your own. So if you find out that you have an AGI of 140, figure out a way to drive it down to 138 so you can have a Roth IRA, right? You really do control your own destiny, okay? And I think that's what's going to enable you to be wealthier in the future. It may not sound like a lot, but if you just save $2,000 or $3,000 extra a year because of your knowledge, take the time value of money into consideration and think about what that means. $2,000 a year for 35 years. That's $70,000 nominally, but once you invest it, it becomes six figures, okay? So we're making good choices here. That's why you need to understand how this stuff works.